In this module, we begin by looking at the scope and boundaries that exist in carbon accounting. Now, carbon accounting is a vital component of environmental management and sustainability efforts, and it provides organizations and individuals with the means to quantify and trace their carbon emissions. The process involves measuring and reporting the carbon footprint, which encompasses both direct and indirect emissions. To effectively implement carbon accounting, it is essential to define the scope and boundaries of the assessment. This lecture delves into the intricate world of carbon accounting, exploring its scope and boundaries and emphasizing their significance in understanding and mitigating climate change. Carbon accounting is a subset of environmental accounting that focuses specifically on tracking and managing carbon emissions. It involves systematic approach to measuring and reporting greenhouse gases, GHG, and they're called emissions, with the ultimate goal of reducing these emissions. The primary GHGs of the concern include the primary GHGs of concern include carbon dioxide, CO2, methane, CH4, and nitrous oxide, N20, among others. Accurate carbon accounting allows entities to understand their emissions profile, make informed decisions for mitigation, and demonstrate a commitment to sustainable practice. Now we're going to look at the scope of carbon accounting. The scope of carbon accounting refers to the extent to which an entity measures and reports its GHG emissions. It typically encompasses three distinct scopes, as defined by the Greenhouse Protocol. Scope number 1, direct emissions. Scope 1 emissions are direct emissions generated from sources that are owned or controlled by the reporting entity. These emissions include those produced by combustion of fuels on site, such as the use of natural gas for heating or company-owned vehicle fleets. Then there's Scope 2, indirect emissions from energy consumption. Scope 2 emissions are indirect emissions associated with the consumption of purchased electricity, heat, or steam. They result from activities outside the organization's boundaries, but are essential to the organization's operations. Finally, there's Scope 3, other indirect emissions. Now, Scope 3 emissions encompass all other indirect emissions that occur as a result of an organization's activities but are not directly owned or controlled by the organization. These emissions are often the most extensive and complex to measure, involving a wide range of sources like supply chain activities, employee commuting, and business travel. The decision to include Scope 3 emissions in carbon accounting can significantly expand the scope of the assessment and provide a more comprehensive view of an organization's environmental impact. However, this expanded scope also presents challenges in terms of data collection and boundaries. Boundaries are the limits or constraints within which carbon accounting is performed. Establishing boundaries is a critical aspect of the process, as it defines what emissions are included, what are excluded from the assessment. The boundaries are determined based on the following consideration. There are operational boundaries. Operational boundaries refer to the organization's physical operation limits. These are boundaries within which an organization has direct control or influence over emission. Determining operational boundaries is relatively straightforward for Scope 1 emissions, as they are directly associated with on-site activities. However, for Scope 2 and 3 emissions, operational boundaries can be more complex, especially when considering supply chain and long-distance commuting. There are also organizational boundaries. Now, organizational boundaries are broader than operational boundaries and encompass the entire organization, including all its entities, subsidiaries, and facilities. In these cases, or in some cases, organizations may choose to consolidate emissions from multiple entities, while in others, the focus may be on individual entities or facilities. This decision depends on various factors, including organizational structure and regulatory requirements. Then there are financial control boundaries. Financial control boundaries are used to include emissions from entities in which the reporting organization has financial control, even if they are not fully consolidated into the financial statements of the organization. This approach ensures a more comprehensive assessment of emissions, but can be administratively challenging, especially for large multinational corporations. There are equity share boundaries. Equity share boundaries are relevant when an organization owns a significant share of another entity but does not have full financial control. In such cases, a portion of the emissions may be reported based on the percentage of equity owned in that subsidiary. There are geographical boundaries. Geographical boundaries consider the location of emission sources. For multinational organizations, determining whether emissions from international operations should be included can be very complex. Different countries may have varying reporting requirements and emission factors. There are also time boundaries. Time boundaries establish the time frame for which the emissions are measured and reported. Common reporting periods include annually, quarterly, or projected specific durations. The choice of the report period can impact the accuracy of emission data, and it is essential to be consistent in setting these boundaries. So this is all very complex. The significance of scope and boundaries. The scope and boundaries of carbon accounting play a pivotal role in the effectiveness and relevance of emission assessments. Here are some key reasons why they are of utmost significance. Comprehensive assessment. Determining the scope of carbon accounting ensures that an organization or individuals not only aware of their direct emission, but also consider indirect emissions. This holistic view is crucial for a comprehensive understanding of carbon footprint. Transparency. Defining clear boundaries in carbon accounting allows for transparency in reporting. Shareholders, including investors, customers, and regulatory bodies, can gain insights into the organization's efforts to track and manage emissions. Performance evaluation. With well-defined scope and boundaries, organizations can evaluate their performance and set meaningful reduction targets. This supports the transition to sustainable practices that can enhance an organization's reputation. There are mitigation strategies. Scope and boundaries help organizations identify emission sources and their relative contribution to the overall carbon footprint. This information is available for devising effective mitigation strategies which can lead to substantial reduction in emissions. It's also regulatory compliance. Different regions and jurisdictions may have specific requirements regarding carbon reporting. Defining the scope and boundaries in line with these requirements requires regulatory compliance and minimizes the risk of penalties. Risk assessment. A clearer understanding of scope and boundaries enables organizations to assess risks associated with carbon emissions. This includes potential supply chain disruptions, increased costs and the carbon pricing mechanisms, and reputation risk. Also, benchmarking comes in here. Organizations can now compare their emission performance with industry averages or industry peers, where there is consistency in defining scope and boundaries. Benchmarking allows for competitive analysis and opportunities, of course, for a corporation to improve. There are many challenges in defining boundaries. While the benefits of setting clear boundaries in carbon accounting is evident, these challenges are associated with the process. Data availability is a big one. Collecting data on emissions, especially for Scope 3 sources, can be very challenging. It often relies on the corporation of external entities such as suppliers, which may not have consistent reporting practices. The quality of the data can be a problem. Ensuring the quality and accuracy of emissions data is essential. Incomplete or inaccurate data can result in misleading assessments. There's a problem, too, of data aggregation. Aggregative data from multiple sources, particularly for organizations with complex supply chains, can be very, very labor-intensive and very time-consuming. Scope inclusions. Deciding which of the Scope 3 emissions to include is often a matter of judgment and strategy. Some entities may choose to report comprehensively, while others focus on narrower set of categories. There are also cross-border challenges. Multinational organizations must navigate varying reporting requirements and methodology across different countries and regions. So you can see this is very complex. Equity, share, and financial control. Now, determining the level of financial control at the organization or this entity and the share required to include emissions in the assessment can be very subjective. In conclusion, this is a huge area. Scope and boundaries are a fundamental concept in carbon accounting. They shape the extent and accuracy of the emission assessments. Now, defining the scope allows organizations and individuals to understand the extent of their carbon footprint, while setting boundaries determines what is included or excluded in the assessment. Clear scope and boundaries are essential for transparency in reporting and performance evaluation, in complying with regulatory bodies, and with estimating risk. However, they also come with challenges related to the availability, the quality of data, and the strategy. Finally, in the face of climate change, effective carbon accounting with well-defined scope and boundaries is an indispensable tool for tracking and managing emissions. As stakeholders continue to demand greater transparency and sustainability efforts from organizations, the role of carbon accounting in promoting environmentally responsible practices is more critical now than it ever has been. By embracing the challenges and refining methodologies of the organization, and individuals can contribute greatly to a more sustainable and climate resilient future. Now that concludes the introductory lecture. Now I also have there for you a quiz to test your understanding and assignments to deepen your understanding. So please take a few minutes and go through those. Thank you.